Hello, everyone. It's Professor Reiko here again. Today we are starting our first video on the income statement. So we just wrapped up everything on the accounting cycle. So if you remember that, just to refresh our memory, we had, we did all of our journal entries, a trial balance, and our adjusting journal entries. And then we did an adjusted trial balance. And the next step after that was to do our financial statements, which we kind of skipped over at the time and went straight to our closing entries. But what we're going to do now is work on the income statement and talk about some other things, another statement, the statement of stockholders' equity. And then we're also going to, the next section of a couple of videos will be on the balance sheet. So let's get started with the income statement. All right, so the income statement, and you can see up here, it might also be called the statement of earnings. So when you see earnings or income, it means the same thing. All right, so a lot of times if you listen to the business press, they'll talk about earnings more than saying the word income, but those words are used interchangeably. All right, so it just measures the operating performance for the period. All right, so the income statement helps investors and creditors predict amounts, timing, and uncertainty of future cash flows by evaluating past performance. All right, so this allows, all right, so by evaluating past performance, it allows comparison to our competitors. All right, so if we're an investor, all right, we're able to look at this and compare it to our, to our competitors or the company's competitors to help us determine whether we want to invest in them or not. Providing a basis to predict future cash flows. All right, so this helps determines trends. And what you'll find is the statement of cash flows is extremely important. So companies, analysts, especially financial analysts, want to be able to help predict those future cash flows and then discount those back to try to get what they think is an accurate stock price at the time. And then also it can help assess risk or uncertainty of achieving future cash flows, right? So these are just three things that allow the investors and creditors to predict the future cash flows. All right, there are some limitations with an income statement. It's limited in that unmeasurable items might be omitted. Different GAAP methods can be used. For example, LIFO versus FIFO for inventory. Now, a lot of this stuff we'll get to in future videos. On depreciation, there's different types of depreciation that can be used. And there's, you'll see as we go through all the modules for intermediate accounting that there are a lot of different places where we can choose between methods to use, but they're both considered generally accepted accounting principles. It's also limited that there are lots of judgments or estimates. All right, I mean, if you think about, judgments and estimates, depreciation, we estimate useful life and salvage value. Bad debts, we estimate, and this we'll get to in the accounts receivable module, we estimate how much we expect people not to pay us. Warranty expense, we'll get to that in the liability section, is we try to anticipate how much warranty work we might do on a product that we sell. Firms might also manipulate earnings. There's a wide array of literature on earnings management, but they might also manipulate earnings to meet the earnings benchmarks. For example, if an analyst forecasts that their earnings, the company's earnings should be $1.37, then the company wants to beat that number, meet or beat that number. So they might, move some things around and maybe manipulate some of the numbers in order to get to that point, right? So that affects the quality of the earnings number report. All right, so the elements of the income statement. So we'll talk about now what goes into it. And then also kind of how it should flow, and then we'll look at an example from Home Depot. So the elements of the income statement. So the main things are revenues and expenses. All right, so we know that revenue less expenses equals net income. All right, the other items that go in here are gains and losses. All right, so dealing with our revenues here, our main items is going to be sales revenue. All right, if you're a service company, that would just be called service revenue. All right, so that's usually your main top line item for all companies. All right, you might also have kind of in the other sections of your income statement, you might have interest revenue or dividend revenue or anything like that. But your main ones are going to be sales revenue and service revenue. All right, now with expenses, this deal with all the expenses of the company. So there's lots of different expenses. I mean, you have wage expense, you have depreciation expense, you have utility expense, insurance expense, and we could go on and on. But these are all the expenses of the company that it takes to run the company. All right, gains or losses, you can see the definition here, increases or decreases in the net assets for transactions other than those that result from revenues or expenses or investments and distributions to owners. All right, so, whenever you sell equipment, so if we sell equipment, we are going to compare the book value of the asset to the sales price. So remember, book value of the asset is the historical cost less accumulated depreciation. And depending if we sell it for more than what the book value is, we'll have a gain. If we sell it for less, then we'll have a loss. So that's an example of where we'd have gains or losses. All right, but once again, we'll get to gains and losses on sales of fixed assets when we get to our fixed assets lessons. All right, so as you can see here, we have a multiple step income statement as one possibility, and then down here at the bottom, a single step income statement. All right, so a multiple step income statement is what most companies was the format that most companies will use. So when I'm teaching, I expect my students to understand that. For you, just make sure you understand what your teacher expects out of you, so you can make sure that you've got your bases covered when it comes to the different types of income statements. All right, so the sections of the multiple step income statement. And then what we're going to do on the next page is look at the example from Home Depot. We'll kind of see these sections broken up. All right, so the operating section, this is kind of the main one. This includes your sales revenue, cost of goods sold, all your expenses, and so forth. All right, this non-operating section, a lot of times you'll see people refer to this as like other revenues and expenses or other gains and losses or a combination of that. All right, so that's going to list out your interest revenue, any gain or loss you had on equipment or anything like that. And then you're going to have your income tax provision laid out after that. And then, so when you get to this point right here, so these first three, this is called income from continuing operations. All right, so income from continuing operations. And then for these two items right here, companies might have these. They might not either. Sorry, that's an H. So these two may or may not be there. So if these two items are either one of them, this will be income from continuing operations, and then we'll have net income down here. All right, if these two items are not included, then income from continuing operations, and I'll just put or, would be net income, meaning that would be the last number since we wouldn't have those on. And then all financial statements, all income statements, I should say, have to disclose the earnings per share for the company. So that's just a given for those. All right, so what you'll find is companies report a very condensed version. There's not a lot of detail in their financial statements, in the actual financial statement. So what you'll see is when you are looking at companies, the notes to the financial statements, which will be the 30, 40 pages, whatever, that follow the financial statements, that's where the bulk of your information is. All right. All right. So this single step income statement, like I said, just to understand what your professor expects out of you, but it typically just breaks things into two categories: revenues and expenses, and then list out taxes separately. So you're still going to get to the same income number. It's just a different way of presenting it. But like I said, most companies stick with the multiple step income statement. So we'll do that. All right. So kind of focusing back up here in the multiple step income statement, let's switch gears and look at Home Depot, and we'll kind of see those sections broken out. All right, so this is Home Depot's. If you look up here, you can see net sales. All right, so this is my sales revenue number, and it's probably sales revenue less discounts and less any returns and allowances. We'll get into all these items later, but it says net sales because it's already done that math for you. Cost of sales, a lot of times you'll see, I will call this cost of goods sold, same thing. Don't let the different terminology confuse you too. They're doing the same thing. All right, and that gives us gross profit. All right, so gross profit is basically the number that tells us how much we have left to cover all of our other expenses. All right, so starting right here, all these numbers are subtracted. from the gross profit to get down to net income. All right, so selling, general, and administrative. So that is, I mean, that's probably hundreds of different expense accounts for Home Depot. They have depreciation and amortization broken out, and then they have this impairment loss. We'll talk about impairments when we get to later chapters. All right, so you can see here, that's our operating income. All right, so operating income was one of the first section on the previous page, which basically was our sales, cost of goods sold, and our main expenses. All right, so this right here is that non-operating section, or the other section. So this is our interest revenue, investment revenue, interest expense. All right, so notice how this is income, but over here it's subtracted. All right, that's because all these numbers are expenses after we, in the operating expense section. So we have to subtract the income number from that. They have an other, which there's no telling what that might be. And then here's our earnings from operations, okay, before taxes. Here's our provision for income taxes, and this is net earnings. So like I said, if we had discontinued operations or the non-controlling interest, this would have been called income from continuing operations. So make sure you understand that. So if we had discontinued operations, this line right here would be income from continuing operations, and then down here we would have discontinued operations, and then we would have net income under that, right? And then to close it out, all companies disclose earnings per share. Earnings per share is a big part of, it's basically a whole chapter in your textbook, regardless of which textbook you're using. And so we will get to that in great detail and talk about basic earnings per share, how we get that, diluted earnings per share, what causes it to be diluted, and things like that. All right, so this is, if you really need to focus on this one, I like showing the Home Depot example because it gives you, an example of what a company actually does. All right, and what an actual company's income statement looks like. You notice they also use the term earnings instead of income. That is fine. All right, so hopefully you enjoyed this video. We'll continue on with some examples and also talking about a few other things that might, discontinued operation and any kind of uncommon things that aren't on everybody's financial statements. So I hope you're enjoying these videos. Please hit the like button. Feel free to subscribe so you can stay up to date with the next videos, and I hope you stay tuned. Thanks.